Everybody, good to see you back with us again this month for another WASD crop report. My name is Arlan Suderman, Chief Commodities Economist with StoneX, and I'm glad you're back here today. I was just wondering what kind of a crowd we would have, considering that it's active harvest pressure. So a lot of our people who normally on here are actively involved in one way or the other with the harvest, and it was a relatively uneventful report. So that gives us more time to spend on some of the other factors affecting the markets, both currently and longer term. And that's kind of the approach I'm going to take today. We'll go over the numbers, obviously, but there's a lot of other things to talk about. So that's what we're going to focus on and go forward. And of course, if you have any questions, be sure to put them in the Q&A box that's in the lower right hand of your screen. So let's get started. Price is a function of supply and demand as modified by the flow of money. The flow of money just simply modifies at what level the market manages supply and demand, and to some extent the timing, but supply and demand are still the critical components of the market. If we're going to talk about money flow, we have to start talking first of where we're at in monetary policy, in inflation. We see the latest numbers to come out on inflation yesterday. The consumer price index, the headline number down to 2.4%, getting ever so close to the Fed's mandated 2% level. However, core inflation that excludes food and energy sectors ticked higher for the second month in a row, is up to 3.3% right now. So that's a concern going forward. And as we look at what components are really driving that, you see on the left-hand side a breakdown of categories on the month-to-month basis, and you see that apparel costs, airfares were the big increases in inflation, whereas on the bottom there, you see that fuel oil and motor fuel saw significant drops in September. So what would inflation have been if we didn't see that decrease in fuel prices? It would have been higher, the headline number, than what it ended up. On the right, you see the year-on-year changes. And so looking back over the past year, again, the decline in used car prices, motor fuel, and fuel oil are the big reasons why we've seen the headline CPI number come down. On the other hand, motor vehicle insurance is the biggest reason that we've gone up significantly. Now, there are other factors as well, but when you look at motor vehicle insurance, and a lot of this is actually due to a surge and just an explosion in car theft numbers, particularly in states that have relaxed some of their bail programs and in the prosecution of people who steal cars. The insurance, we all pay for that in higher insurance rates, especially in those states, and that's been one of the bigger factors. But food has also been a major contributor, as well as shelter, as you can see there in these numbers. So let's move on. Why has the economy been so resilient, even as the Fed has been in a monetary tightening mode now for about the last, 15 months or so? And actually longer than that. It's really I guess it's longer than that. It's really been since March of 22, since they started withdrawing money from the stimulus from the economy, shrinking their balance sheet, and raising interest rates. But we've been seeing, initially, we saw the monetary base go down, but it's been trending higher over the last year or so. And I've been saying that a lot of that is because of the fiscal stimulus that we still see in the system. And ironically, one of the things that I've been watching for, and we now see happening, is we are seeing the credit markets starting to tighten. And the Fed has already reduced the rate at which it's shrinking the balance sheet once. And I believe that at the next meeting, they will reduce that rate again. And I believe at some point next year, they will have to quit shrinking the balance sheet, and we're moving back toward quantitative easing again. And one of the reasons for that is that because we are increasing the supply of debt certificates at such a rapid pace right now, that we don't have enough buyers, and we're going to be moving into that lacking of buyers, with foreign buyers taking their money home for reasons of better opportunities at home, and retail buying starting to slow. That you have an increased supply of debt certificates, a decreased demand, that decreases the value of the debt certificates, that increases the yields. And so I think particularly medium and longer term debt interest rates, that's one of the reasons we're seeing some of that upward pressure in like the 10-year treasuries. Now, as we look at the health of the economy, I'm going to say right up front, yes, there are segments of the economy that are struggling. Portions of the manufacturing sector are in recession still to this day. Housing sector has really been struggling. But with lower interest rates, we expect the housing sector to come back as consumer confidence comes back. That's one of the factors that's still waning. And as we saw in consumer sentiment today, much of that seems to be waning on the elections and what happens there. Now, the broader economy, second quarter GDP at 3%. We will soon get the numbers on the third quarter GDP. The models right now have it around 2.5%, so a little bit slower, but still relatively solid GDP growth. If we look at the unemployment rate, back in August, rose to 4.3%. Now, those of you who have some gray hair on top like I do, remember that 4.3% is historically still a low number for unemployment. We feel for that 4.3% that's unemployed, but from a big picture economic standpoint, that's historically a low number. But yet at Jackson Hole, Wyoming at the end of August, Jerome Powell, chairman of the Federal Reserve, said, we can't let it go higher. He lowered the ceiling and said, if it goes higher, we're going to have to increase our speed at which we cut interest rates. But since then, what has it done? It's gone down in 4.2% with the jobs report we got in early September, 4.1% with the jobs report that we got 1st of October. And not only that, the number of jobs created in September were nearly twice what was anticipated. Now, government jobs are a big part of that. I want to be upfront with that. But we are seeing some expansion in private sector jobs, especially at the lower income level, leisure and hospitality. That was the last sector to really catch up after the pandemic. But we're seeing some improvement, but a lot in the surveys, industry surveys, particularly some of the PMI, Purchasing Managers Index surveys, et cetera. And we're seeing industry saying they're waiting until the election to really decide what they're going to do on employment. A lot of tax, potential implications of tax policy going forward that could impact hiring practices going forward. Remember the big tax structure change that we had during the Trump administration is scheduled to expire next year. And that will have major implications on the firms that do the hiring. If it's allowed to expire, their taxes will go up significantly. Some of their abilities to write off expenses will go up, and that will decrease their willingness to hire. And so that is what they're waiting to see based on the campaign promises made by the two candidates. And right now, it's pretty close and tight in the election. So if we look at tying this to commodities again, as I showed you last month, when we got had the big yen carry trade unwind there at the 1st of August, we broke the 5-year break-even inflation rate down below that support level at about 2.1%. But we have climbed back above it. And look how commodity prices have responded as well. Now, which came first, the chicken or the egg? And it typically goes inflation expectations lead money flow into commodity prices. This time it was almost simultaneously, and especially after the 50 basis point rate cut on September 18th, we saw inflation expectations go up. Now, this is still not enough to confirm a longer-term move. This could still be an aberration, as we had back in late April, when reinflation expectations were coming back, and we saw that rally, that spring rally in commodities. This may still be an aberration, but it is something worthy of watching, and it continues this day, as we've seen a lot of short covering in the commodities over the last several weeks. So that's something we're going to be monitoring. This relationship, notice the correlation is pretty strong at 0.86 there at the bottom. When you look at commodities versus the CPI, the headline numbers, I said, still ratcheting lower. I probably ought to compare this to the core CPI now that I think about it, based on what I just said earlier in my comments. I'm going to take a look at that, and that would be interesting. But the headline number here, correlation over the last 10 years of 0.85. And the commodities, though, showing more resiliency. And historically, over this period of time, we have seen that eventually result in a return of reinflation. There's obviously more to inflation than just commodities, but there is a relationship there. So we look at just the grain and oilseeds part of it, that relationship's a little bit stronger, a correlation of 0.88. And again, we see those commodity prices go up. We don't know yet if this is just a near-term aberration, but certainly something that we are watching. I do expect reinflation pressures to gradually increase as we go into next year. And if we see a more significant increase in energy prices, then that would accelerate those reinflation pressures. Right now, that would probably take an escalation of the war in the Middle East to a broader regional conflict. I'll talk about that a little bit more here in a little bit. Outside of that, we're still well supplied with energy. If we look at the livestock subtractor, that correlation has gone down to 0.57, largely because of the tightening supply of protein we have, largely because of the tightening supply of cattle that we have. That has kept cattle, therefore beef prices, elevated. So therefore, we've seen this ongoing protein sector trend higher, even though the CPI has been coming down overall. Looking at energy, strong correlation here, 0.89. That makes sense. Energy goes into everything that we do virtually. It's not just the cost of putting gasoline in our car or diesel in the truck that hauls freight, but fossil fuels also go into the packaging of what we buy at the store. It goes into so much of what we do. Energy is such a part of making plastics that go into our products, making our chemicals, making our fertilizers. So much of what we do relate to the price of energy. And so there's no question about it that there's a correlation there. And again, on the right-hand side, you see that rally, even as the headline CPI is going lower. And we'll have to see if this is just an aberration or something that has a little bit of substance to it. The softs, 0.64 correlation, anything above 0.7 is considered significant. And overall, I think this is largely due to what we've seen in cocoa, with tight supplies helping to lift that sector. Now, if we look at what I'm going to call food-based, I know there's other commodities, cocoa, for example, that is also a food, but this is the grain and oilseeds and livestock. Look how we had virtually a net short position all not that long ago, but the funds managed money has covered most of those shorts. And granted, they were been long in the meat sector, especially the cattle market, for quite some time to varying degrees, but now we're net long for those combined sectors overall, and something we're going to continue to watch. If you break it down by sector of everything that's in our commodity tracker, looking at the subtractors, we see, and this is looking at 12 months, 1 year's time, we see that the poorest performing over the last 1 year has really been the energy and the grain and oilseed sector, and those had strong correlations to inflation and inflation expectations, but they are both turning higher now. What was the strongest? Precious metals. If you follow the precious metal markets, all you know that gold has been making record highs. But also the softs have done well, as I mentioned, followed by industrial metals. We've got 21 different commodities in our basket, our StoneX Commodity Index Tracker. Industrial metals are taking on a larger portion of that. We continue to monitor, and that's largely due to the move toward electronics, technology, artificial intelligence, and electric vehicles. Now, kind of sum it up in the ag commodity dynamics, managed money is now currently focusing on reinflation risk. They did so back in April as well, and it didn't last more than a few weeks. We'll have to see if this has more staying power or not. That just simply raises the level at which the market manages those same supply and demand fundamentals. Fundamentally, most of our major commodities are amply supplied. Corn, soybeans, we have plenty here in the United States. But inflation expectations can change at what level we manage that. Now, we did have just a very short port strike before an agreement was reached to give the port workers 61.5% increase in pay over the next 6 years. Now, that doesn't settle it. There's a lot of other issues like bringing a halt to automation, et cetera, that still have not been settled. So they just agreed to a little over a 90-day agreement. January 15th, we could be looking at a port strike again. And if we have that, it can cost our economy $5 billion per day. That the fact that we've averted it near term is good for our economy and allows us to continue to move forward. But we'll have to keep our eyes on that come January. Now, much as I said, much of the decline in inflation was due to commodity deflation pressures, but it looks like that might be now reversing. We'll have to see what the staying power is of that. Longer-term interest rates increasingly reflect the rise in the supply of U.S. debt certificates. U.S. tax structure vulnerabilities increase as we go forward, and I expect that the Fed may soon slow or even halt shrinking its balance sheet, if not starting to increase it again via quantitative easing. What is quantitative easing? It's creating money in order to buy our debt certificates to keep those interest rates from getting too high. Buying our debt, creating money to buy our debt, monetizing the debt, words that the Fed does not want to use, but that's essentially what it would be. Okay, let's look at geopolitical risks. First, China. Its economic data is rather bleak. It really is. Now, it is really interesting, and they've largely indicated that they were limited in how much stimulus they could do until the U.S. Fed start cutting interest rates. And that's because they want to keep their currency, the yuan, as seen in the world trade as a viable, strong alternative to the U.S. dollar. So if we have high interest rates and therefore a strong dollar, and they're stimulating, then that would tend to put downward pressure on the yuan. They didn't want to do that. They'd rather sacrifice their economy. But on September 18th, when the Fed cut interest rates by 50 basis points, that gave them a leeway to start stimulating. Now let's tell some more details here. Last week, they celebrated their 75th National Day holiday. It's a week-long holiday. Now, what is this holiday? It's celebrating the anniversary of the Chinese Communist Party taking control of China 75 years ago. So it was a big deal. Consumer sentiment was in the pits near record low levels. They did not want people traveling to relatives and friends and just griping about the government. They wanted consumer sentiment picked up. The Fed cut interest rates by 50 basis points, giving them just enough time to announce a big stimulus packages ahead of the holiday. They also acknowledged that one of the keys to turning around consumer sentiment was to see a rally in the stock market. So we see the big packages announced. Not a lot of details, but the big picture kind of programs announced. And then the stock market started going up, and we watched this. And who was buying? It was the state-backed funds who were buying. And once the stock market started getting some upward momentum, then a lot of the private money came in and helped accelerate it. And And we would see times when the market would start to stall out and start to turn down again, and state-backed buying came back in and pushed it higher, and then the private money came back in again. So that by the time our holiday started, the stock market was up, depending on which index you look at, was up 26 or 28%, most of that in 1 week's time. It was pretty impressive overall. But then the holiday, everything paused. Came back from the holiday and traders saying, okay, now we want some details. And there were plenty of announcements and statements and press conferences after the holiday this week as the markets reopened on Tuesday, but they were all lacking in the details that traders are hoping to have. And so the market started coming back down in profit taking, and the state-backed funds would come in and buy. And initially that helped, but then it lost its ability to stop the selling, and the market just started collapsing. So that now by the end of this week, the major indices have retraced back down roughly about half of what they gained in the week ahead of the holiday. And so this is a critical time right now for Chinese authorities in being able to salvage their economy and be able to turn things around. Because if they lose this opportunity, if skepticism comes back in again, it's going to be that much harder to rebuild confidence again down the road and take that much bigger initiative. So the expectation is that we're going to see additional stimulus come and more details coming and more substance. But that's probably what it's really going to take to get things going, because right now consumer sentiment really isn't turning to the degree that they need it to turn. Simultaneous to that, we have seen recently joint military maneuvers with Russia near Japan. We've seen an increase in intensity and frequency of military incursions near Taiwan. And even late last month, we saw China launch an intercontinental ballistic missile into the high seas of Pacific. And then they boldly announced it. Now, that was sending a message, probably to us here in the United States, but it was sending a message. Previously, they've done a lot of missile testing in the past, but it was usually in the back country of the deserts of what I want to say, Western China. And then if questioned about it, they would deny it. This time they did it, sent it into the high seas of the Pacific, and they announced it boldly to send a message simultaneous to the military maneuvers with Russia, the joint maneuvers, and the intensifying activity around Taiwan. So I would say that the risk of an accidental war is increasing around China right now. And if that were to happen, or even if it's intentional on China's part regarding Taiwan, which I think their preference is to take Taiwan without military action, but Xi Jinping has promised he will do it. And he's watching and interpreting the election results as he would do. I can't even say how I can speculate on what that may be, but we don't know what's going on inside of Xi Jinping's head. But what we do know is if something were to break out by accident or intention, it would be considered, we believe, bearish on the commodity side, because the expectations based on history would be sanctions initially, and sanctions would make it more difficult for their buyers in all likelihood to be able to purchase our commodities and take shipment of them. Black Sea, Ukraine has increased its incursions into Russia, established a Russian territory in the Kursk region. That puts them in a better negotiating position for a peace agreement, because Russia had been saying, okay, we'll talk peace, but we want to make sure we get to keep everything that we've gained control of over the last couple of years. Ukraine, that's a non-negotiating point. So what they did is they found a weak spot in Russia, and they took off into Russian territory and claimed some Russian territory. Now they're in a better position to negotiate. We've seen Ukraine also conducting deep airstrikes into Russia on their energy infrastructure and some other key military targets. Russia has increased dramatically its hits on grain infrastructure in Ukraine, including now hitting grain cargoes. not with enough frequency to get the market really concerned about it at this point. But we have seen over the past week reports that we cannot verify, but reports that insurance rates have gone up about 30%. And even reports that some shippers are canceling use of their vessels. If we see this trend continue, the question is, at what point does Ukraine start to retaliate on cargoes coming from Russia? This is what has the potential to impact commodity prices to the upside, since this is a major commodity export part of the world. Right now, grain exports remain near normal for both grain and energy, but that's something we'll have to monitor closely. The market currently lacks a war premium, so any peace agreement we would expect to have a relatively minimal impact. But if we continue to further escalate, that does risk the need for increased war premium in commodity prices. Middle East. Israel is shifting the focus now to Hezbollah in Lebanon, while continuing to complete its war on Hamas in the Gaza Strip. The leadership of Hezbollah has been taken out, along with the next people expected to step up into those leadership positions, along with blowing up the pagers and the phones that Hezbollah leadership was using. So Hezbollah has taken a major hit, and they're now talking about the possibility of peace talks. And for the first time, they failed to even mention the need of Israel to get out of Gaza in order for those peace talks to start. So Hezbollah appears to be significantly weakened. And Hezbollah and Hamas have largely been the proxy groups for Iran to fight Israel. So if Israel is effectively rendering those groups ineffective, then does that force Iran to get more involved? Now, Iran did strike Israel on October 1st with roughly 180 missiles. Israel has promised retaliation in the way and in the timing that they deem in their best interest. Now, the reports out is that Iran, in order to attack strategic points in Iran, Israeli bombers would have to cross airspace of other countries. And so Iran has reportedly been secretly reaching out to all those countries and saying, if you allow Israeli planes to fly through your territory, then your assets are going to be at risk as well. So this does have the possibility of expanding. We know that Iran hit our Saudi Arabian energy infrastructure, and I believe it was 2019. So that risk is there, particularly for energy and for fertilizer, because 52% of the world's urea exports come from the Middle East and North Africa. So that's at risk. There's also a lot of phosphate and some potash that comes out of the Middle East as well. But I did see today one report that Israel therefore may retaliate via cyber attacks on key Iranian assets. So that may be how they do it. Don't need to worry about the airspace. But the expectation is that they're going to retaliate Iran. And then the question is, how will Iran respond, and will it broaden its retaliation on other, quote unquote, friends of Israel and the United States? The concerns are primarily on energy infrastructure, but we have to be concerned about fertilizer as well. Now, as we look at weather risks going forward, I've talked in previous webinars about the nearly ideal weather we had in July and for the first 2/3 to 3/4 of August. But since September 1st, it has really turned off dry across the Midwest. The exception being the moisture that came in from Hurricane Helene. Now, these are climate reporting districts, and these numbers represent the rankings for rainfall over the last 132 years of records. So you can see the northwestern Midwest has had one of the driest periods, the last 70 days, essentially, going back to September 1. To September 1, so that would be more like 40 days. I did another graphic going back to August 1, but that was for Russia, and you'll see that in a little bit. The last 40 days, essentially, it's been the driest 40-day period for this time of year on record or close to that northwestern Midwest. We were also pretty dry in the southeast, but Helene took care of that with its unfortunate, very heavy flooding rains that we saw in that region. And so that reversed it. But overall, this had to have had an effect on taking some of the top off of this year's crops. Temperature-wise, northwestern Midwest, the hottest on record for that time period as well. Much more mild, normal temperatures overall on average across the southeastern Midwest and into the southeast, with the exception of Florida, which was pretty hot overall, one of the hottest periods over the last 40 days on record. Very dry as a result of that pattern. Obviously, Helene had an impact on curing some of the dryness in the southeast. One of the concerns going forward is if you carry these dry soils into the winter and through the winter, and we are in that period of time when it gets more difficult to refill soil profiles, then that becomes a feeding mechanism for possible drought development the following growing season. Couple that with the fact that we have a developing La Nina right now, and that La Nina is expected to peak sometime in January and then to start weakening again. And in years after a La Nina, you don't guarantee this to happen, so I don't want to be over sensational here, but the risks do go up in a year after a La Nina. The risks rise for a Midwest drought the following growing season. So this is something we're following. This is not a prediction on my part. It's something that Eric Snodgrass, who I quote and use some of his materials, he's with Nutrient Solutions. I think he's an excellent climatologist. He's been kind of raising that risk factor, that warning here of late, not predicting it. He's not forecasting a drought next growing season, but he said it's something we're going to have to keep our eyes on. So ideally what we need to do is turn this weather pattern around to start refilling those soil profiles before the ground freezes. Now, we are seeing here in the equatorial Pacific, we are seeing these blues become more consistent. And that means that the eastern trade winds are picking up with more consistency now. And so we're moving into a weak to moderate La Nina. And that's what the forecasts overall are calling for, is a weak to moderate La Nina. Keep that in mind. I'm going to come back to that here in a little bit. Notice how we're also cooling a little bit off the west coast. Keep your eyes on that, because that can support drought if that starts getting going. Now, we got a lot of cool waters up here, and that's because we've largely had a low in that area. And that's been our big driving pattern, with high pressure in this area with the warm waters and high pressure in this area with the warm waters over in the North Atlantic. And so our lows have been dipping into the Northwest and going up and over. I probably should have drawn that, and I'm going to clear that out. I probably should have drawn that more like this. And that's been allowing high pressure to be over much of the country, drying us out here in recent weeks. And that's been the predominant factor that we've seen and our current pattern. We are starting to see some signs now that this low pressure that's been up here off of Alaska is going to shift more into this area here. And if that happens, then we can get more of a southwesterly flow. That means you have high pressure over here once again. You bring up the moisture up around it and start pumping it back into the Midwest. And we're going to start going into that next week, it looks like. We're going to bring some colder air in the Midwest, which will be drier, but also start bringing a little moisture back in. I don't think they're going to be drought-breaking rains by any means. But we're going to have to see if this is the beginning of a bigger pattern change. It's too soon to know if it will be. It may just be an aberration, but that's something to watch going forward here in the near term. Longer term, as we look at the November to March weather patterns in a La Nina year, is we tend to see more storms in cold across the north and warmer and drier across the south. That doesn't mean that you can't get cold air dropping down even all the way to the Gulf of Mexico from time to time. But the overriding average tends to be warm in the south, cold in the north, with winter storms focused on the northwest, and then a kind of a rainy, wet, snowy, icy stretch here in the Ohio River Valley. That tends to be the La Nina pattern if it's a typical, and that's what we see here. On the left, you see October to December. Eric is expecting this to be very much continue to be the case for October, but then start to flip as we get into November. And then in January to March, see this pattern that you see more on the right. Now, the greens are above normal. Keep in mind that normal in the wintertime is certainly lower. It starts to pick up the pace in March, which this graphic goes to. But the concerns would especially be for this northwestern area, the Midwest and the plains, but also this area in the southern plains, a hard red winter wheat belt has got to be a concern going forward for a short crop in that area. Now, as we look at the impact on South America, I want to show you this again, this great work done by Commodity Weather Group. The strength of the La Nina makes a big difference. It really does. Now, as I said, the expectation is a weak, maybe moderate La Nina. That gives below 50% odds of a dry summer in center west Brazil, the most productive part of Brazil. And it gives greater odds of having a wetter summer to support good production. If we look at Argentina, it matters a great deal. If it's a weak La Nina, you have 82% odds, statistical odds here, of a dry summer. If it's a moderate La Nina, it's 40% odds. If it's a strong La Nina, 50% odds. So it makes a big difference on what the strength of the La Nina is. Now, as we look at what the weather models are showing, it's been extremely dry in center west Brazil. I'm going to draw out center west Brazil. Hopefully you can see that. It's basically right there. All in all, it's about twice the size of the state of Texas. That is a heavy production area for both corn and soybeans, primarily first crop main crop soybeans, and winter corn, which is their biggest crop. You may know it as safrinha corn crop. That had been dry for months, record drought there. And now over the next 2 weeks, we're expecting 3 to up to 5 inches of rainfall in that region over the next 15-day period. So very wet. And it's been wet down here in the south. Typically, a lot of times in La Nina, that'll dry out, but that is expected to stay wet as well. Now, this year is most like probably the 2020, so 4 years ago to this point. And as you see, we saw a very late planting in Mato Grosso of the soybean crop. And as a result, we saw a very late planting of the winter corn crop after the soybeans were harvested. And that did result in corn yields coming in about 15% below trend. That's just 1 year. I could have also pulled up a year that they planted corn late and they had a good crop, a big crop, above trend crop. But it does increase the statistical risk of a short corn crop. Another one of the reasons, combined with Argentina cutting back on corn acres by about 20%, where I think we could see improved exports as we get into the last half of the marketing year. Here's one of the latest European weekly maps going from mid-October to mid-November. And I circled up here. This is the major soybean growing areas for Brazil. This is the major soybean areas for Argentina, as well as corn. And you can see there's more of a dry bias in Argentina, and their soils are very dry right now, so that is a concern. But that right there, this goes, this is, of course, that month from mid-October to mid-November. That's not concerning. That's actually an improvement over what they have now. But as I go to the next graphic, and first of all, this would support strong production in Brazil, at least a strong start to the growing season. If we look at that January, February, March period, the Brazil crop is largely made then, and you're harvesting soybeans and planting the winter corn crop, which means we'd probably get the winter corn crop off to a good start. But it does have a much drier outlook. This is kind of the core growing season time for Argentina, and particularly northern areas would be fairly dry there, which would threaten this production there. Okay, fundamentals. Here's today's numbers. Not that much different from expectations. 183.8 bushel corn crop, 53.1 bushel soybean crop. That number matched trade expectations. Here's our latest October 1 customer survey. And frankly, if you look at those state-by-state numbers, and if you want, you can look at the on-demand version of this webinar where you can pause it and really study the numbers. And hopefully we'll get that out, if not tonight over the weekend, but at the latest Monday morning. Here's USDA's corn numbers, and there's a lot of similarities to our customer survey there with the number of state records. I think in the last USDA report, and I didn't have the chance to confirm that today, but in September report, we were looking at, I think, 9 record yields for corn, 6 for soybeans. Here's the soybean yield overall. So a good crop. Took a little bit of the gravy off the top with the type of finish we did, but still a good crop. Ending stocks, really, look at wheat and soybeans pretty close to trade expectations, even corn pretty close, but just a tad above trade expectations. There's nothing market moving in these numbers at all. You look at world supplies, we see wheat crop getting a little bit bigger, and a lot of that was because of changes made to the previous year's balance sheet and a softening of demand overall. But corn numbers coming in pretty close to trade expectations, soybeans pretty close to what's been priced in, and even that wheat number is really not that much of a market mover. So if we look at the balance sheet, USDA incorporated changes from its stocks report. So it added about 39 million bushels to feed usage. It added about, excuse me, it added about 10 million bushels to ethanol from the September report, but not a lot of changes overall. Now our yield is 184, so it's slightly above USDA, gives us 19 million bushels more production. My export number is larger, my feed usage number is larger. So I get ending stocks of 1.862 billion bushels. That's 12.3% stocks to use ratio versus USDA at 13.3 million bushels stocks to use ratio. 12.3% stocks to use ratio is not tight enough to justify rationing demand with higher prices. But if in fact some of the things play out as I indicated, we could see this export number go higher and those stocks numbers go lower. We've simply taken out of some of the margin for error should that happen. If we look at the funds, they have unwound most of their short positions. This is data as of October 1, the latest that's been reported. And so we believe that we've done even more fund short covering since that point, although we've seen an increase in farmer selling. If we look at market share, U.S. is losing market share while South America is gaining market share. Mostly as Brazil increases the area that they plant and harvest to soybeans. Now, the United States, we know we're losing market share on the world trade front, largely because China is shifting to Brazil to source its soybeans. So we were all excited about using soy oil to produce renewable diesel and also biodiesel. And so we built new renewable diesel plants, we built more crush facilities, and all of a sudden we started getting flooded with used cooking oil coming from Asia and especially China. This looks at used cooking oil imports. And 2018, 2019, 2020, 2021, 2022, those are not zeros. It's just that 2023 and 2024 have seen so much expansion, I had to change the scale to where it looks like those other prior years are zeros. Now, there are some questions about whether China is selling us more used cooking oil than what they actually use to cook. Or are they just taking virgin palm oil and treating it so it tests positive? And the EPA says the EPA is reportedly looking into that. But look at these numbers. 2023, that huge increase in imports in the United States from China. The 2024 number is up even higher, and that's just the number through August. So there's another 4 months worth of data there. Obviously, it's going to be a record level of coming in. Now, there is a bill in Congress trying to require that to get a subsidy, and without a subsidy, it just renewable diesel, biodiesel doesn't work. To get a subsidy, the feedstock has to have been grown in the United States. It's a bipartisan bill, but we don't think it has the support to pass Congress. So we're not optimistic that it will become law. Even if it does, the California Air Resources Board has proposed capping oilseed use, including soy oil, canola oil, and sunflower oil for feedstocks for the green diesels at 20%. It might turn out to be a battle, if that were the case, between California and the federal government that might get settled in court. And who knows how that would end up, but this Supreme Court has tended to side with the states, and it's believed that other states will follow California. So that's a negative toward U.S. domestic demand for soybeans. And I've largely covered this already. So as we look at the soybean balance sheet, we look here in the middle. I use USDA's numbers from today at our yield from our customer survey at 53.5 bushels per acre. I use USDA's acreage. I come up with 4.613 billion bushels, which is 21 million bushels above USDA. My total use is 21 million bushels above. Crush is about 15 million bushels above USDA. Exports are about 115 million bushels below USDA. We were in the same boat last year. I said that USDA was too high on its exports by 100 and some million bushels. They came down to me throughout the year. I look for the same thing to happen again this year. If you look at marketing year to date, soybean export sales, they trail the seasonal pace needed to hit USDA's target by 137 million bushels. And that number has been kind of holding true even with the recent buying by China. We need to have beyond the seasonal pace, we need to have 76% of our year's soybean exports on the books by January 1st. You can see the funds have covered most of their short positions in soybeans. If we look at wheat, we're just amply supplied all the way around, ending stocks right now at over 800 million bushels. My number is a little bit higher than what USDA's is right now, but we're amply supplied. I do think that as Russia starts assuming they restrict exports, as we think, that we could start seeing some improved exports down the road. Then the question is by which class. We did see USDA cut hard red winter wheat exports today by 20 million and reallocate that to other wheat classes. Hard red winter continues to be the burden with the significant supplies. They're almost a 200-day supply of hard red winter wheat. Most of the world's wheat is in China, 52% of it. If we look at world stocks among major exporters as a percent of usage, we're pretty snug levels right now. And I think if we see China start to restrict exports more aggressively, that's when we see the market start to focus on these tight supplies and other major exporters of the world. And the real concern now is focused on how dry it's been. This is a graphic of actual rainfall since August 1. That bottom graphic shows you how we rank with the past 45 years or so. It's just been flat out dry in much of the winter wheat belt. And they're running out of time before winter for that rain to come and replenish the soils. Again, the funds have been covering their net short positions in Chicago wheat and also in Kansas City wheat. So in summary, the take-home points is the U.S. is well stocked with the primary food-based commodities, especially corn, soybeans, and wheat. World exportable wheat supplies are snug, in fact. Soybeans are currently the most ample. Corn has the best chance to improve its fundamentals in the last half of the marketing year. Storage of this year's fall crops will be a problem, pressuring cash basis. Now, we do expect commodity deflation pressures to be easing going forward, allowing reinflation to come creeping back. The geopolitical risks are trending higher, giving us greater price volatility. Now, I haven't talked yet about the European Union deforestation rule that was scheduled to go into effect on January 1. That has been delayed by 1 year. That is inflationary for commodity prices, and what it basically means that if you're an importer of commodities in Europe and you import a cargo of soybeans from Brazil, you have to provide geolocation maps for every field that those soybeans in that cargo came from, to prove that they had not been deforested since 2020. That's going to be very costly and inflationary, although it could near term boost U.S. exports. But right now, it looks like it's going to be delayed by a year to January 1 of 2025. Overall, I still look for reinflation pressure to return by next year. And with that, I'm going to wrap up my comments and give the opportunity for addressing some of the questions that have come in. So Hannah, are you going to read the questions for me today?
Yep, I sure am. I do think you answered a lot of these in your presentation, though. So I'm going to go to the Strategic Petroleum Reserve is still historically low. Does it matter, or is it domestic production in good enough shape?
Domestic production is in good condition. Now, it still matters, not currently, but long term. If we have a threat to our oil supply, we lack that strategic petroleum reserve. So therefore, we could see oil prices explode up at a faster and higher level. Right now, we don't have that. The only thing holding our oil prices up here, and historically, you look at the way OPEC manages supply and how the market can either bring more production online or take it off line depending on price. That tends to keep prices between that $60 to $80 range pretty well, unless you have some type of a surprise event come in that can push them lower or higher. And I think our energy department's model right now is kind of looking at $75 level for the fourth quarter. I have not studied that model. That's what they say, not that what I say, is what they're kind of saying. But overall, it's been trading largely Middle East risks and putting war premium in there. The concern would be that if Israel were to strike energy assets in Iran and or if Trump would win and enforce the sanctions on Iran that the Biden-Harris administration is not enforcing, that we could lose like 1.7, 1.9 million barrels per day. OPEC Plus is currently curtailing production by over 5 million barrels per day, so they could make that up. But if we see retaliatory strikes on other producing countries, then that ability to make it up would be taken away. And that's what the market is worried about.
Okay. Can you describe the impact of expanded warfare on grain transportation flows and exports? You seem to describe a scenario in which conflict increases, but what happens to commodity exports? What could occur? Who could stop exports?
We've already dramatically reduced the number of ships carrying cargoes through the Red Sea. So many of them are now going around the southern end of Africa. That increases costs, that lengthens freight routes, reducing the number of ships available, which also adds to costs. So that's happening now because of the conflict in the Middle East. It's actually possible, if the war in the Middle East continued to escalate, that you could shut down the Strait of Hormuz, and that is about 30% of our world's energy exports go through there, and there's fertilizer that goes through there as well. So that is a risk to monitor going forward. In the Black Sea, if we see an escalation of attacks on ships to where shippers just simply say, we're not going in there, and that would have to be a much higher escalation than what we currently have, then you would dramatically tighten up supplies of wheat and possibly corn, as well as crude oil supplies, escalating prices there. So those are the factors that I'm monitoring.
All right. Managed money funds have covered a huge amount of corn shorts since July and look to be almost net neutral after this afternoon's report. Do you foresee them slowing down around the net neutral mark, or will they be aggressive enough to establish a materially long position?
Yeah, that's a good question. And at this point, what I'm looking for them to do is simply look at a neutral position. I don't think that there is enough reinflation pressure at this time, nor fundamental support to justify going long. So I'm not anticipating that. They could do so when the farmer is selling because the big crops, and one of the concerns right now is finding a home for all these crops. We don't have enough storage, particularly with the rapid harvest that we're seeing with the rapid dry down of the crop. So we could see maybe temporary long, but fundamentally, we don't have the fundamentals to justify them building length in the grain and oilseed complex at this time.
All right, we're gonna hop over to South America now. It says, if rains finally arrive in Mato Grosso, Brazil, how bare can it be for soybean CME?
It could be quite bearish, particularly if China fails to buy the soybeans that I think, look at my ending stocks estimate at 660 million. And that's assuming in my production estimate, I'm going off my world balance sheet, that Brazil will produce a 165 million metric ton crop, and USDA's at 169, and some private estimates are as high as 171 million metric tons. So if the rains come and are sustained through the Brazilian growing season, we could see that number go higher. That's simply taking area times a trend yield. So we could see those numbers go even higher at a time when Chinese demand is flattening out. The only reason they're importing more than they did last year is because they're building reserves. Overall consumption is flattening out, and that's not a friendly scenario at all. So I'm worried about the downside risk of this soybean market more than I am corn and wheat at this time.
Okay. Do you think that the funds will resume selling corn and bean once the risk of South America crop is no longer on the table?
Right now, that's the focus. And I think that the risk of weather is dramatically lessened already. And part of the weakness we've had here of late is removing some of that weather premium that had been put on there. The other weakness is if once the funds finish covering their short positions, which they're getting close to doing, I haven't seen today's CFTC report, that removes a buyer unless something stimulates the funds to go long, and I don't know what that would be right now. But the farmer is still selling because if he has limited on-farm storage space, it's the beans that he's favoring taking to town rather than corn, favoring using his on-farm storage for corn. So that pushes more bushels onto the market. So it's soybeans that I'm most worried about as far as downside risk.
All right, and one more question. Can you specifically mention countries / grains? Example, India cuts rice exports, etc.
Yeah, India, we've been talking the last year about will they start importing wheat, and that could be significant, but their rice supplies have been large. And historically, whenever they have large rice supplies, they simply don't import wheat. They don't like to import wheat. They simply switch demand over. With those big rice exports, rice supplies, the industry would like to export some of those surplus rice exports. The government is trying to limit that right now and curtail their ability to do so. And so that's a concern to the rice industry, that they could end up with an oversupply and very weak prices and not support their agriculture. But India is really trying to micromanage that, and that's a concern to the industry.
All right, well, that's all we have, and we have hit that 3 o'clock.
All right, excellent. Thank you very much, everybody. Appreciate you being here. Our next one will be on November the 8th. And we should have a good handle on the size of the crops, but I think the biggest focus then will be on South American weather and the size of the crops there and what's developing, and also on whether we continue to stay dry in the Russian winter wheat belt, leading to restrictions on exports. By then, it'll be too late probably to get the crop really established before dormancy, leaving the wheat crop vulnerable in that area. So those would be the two stories I think we'll be talking about, in addition to the election results and possible implications for the commodity markets going forward. So thank you for being here today, and I look forward to having you back next month.